speed DeFi, never on a decline. Building the future, I feel like a savage.
Hello and welcome. I am Piers CEO of RDX Works, a core developer of the decentralized finance protocol, Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the products, assets, and services that are powering the DeFi revolution. Today, I'm joined by Martin de Rijk, head of growth at Maple Finance and Syrup. Maple is the largest institutional DeFi lending platform, providing yield opportunities for capital allocators to earn yield on their crypto and provide financing to some of the largest crypto institutions in the crypto space. Syrup makes institutional yield accessible in DeFi and provides the most consistent, high yield backed by over-collateralized loans, making those accessible to DeFi applications such as ETHify and Pendle. Maple, to date, has done almost $5 billion of loans and currently has a TVL of $500 million. Syrup, launching 3 months ago, currently has a TVL of $200 million. Martin, thank you so much for coming on the show.
For sure. Yeah, thank you for having me. It's really, really exciting to be here, and I'm really excited to see what you guys are building as well.
Thank you. Thank you very much. I appreciate you taking the time to look into it as well. So let's talk the evolution of Maple and Syrup, because Syrup's a relatively new product. Maple's been around for quite a while. You guys had a really good run in 2020, sort of DeFi Summer, and coming with this, even then, sort of institutional narrative. Back then, it was much more uncollateralized lending. Which obviously sort of in the 2021 era, when we started to see, in 2022, where we started to see the large blow-ups of things like FTX, of things like 3 Arrows Capital, which I know affected you guys directly, there was this sort of this period of a retrenchment, a pulling back from the crypto credit markets in general. And people were sort of asking the questions as to whether or not lending was a good idea in the crypto space in general. In 2022, early 2023, you guys had very, very little TVL. But I'd love to sort of understand, now you're growing again, which is fantastic. Congratulations. You've got a new product that's come out, Syrup. Just talk to me a little bit about sort of your experiences and stories during that time with the team, and how you guys sort of like engineered this sort of return to the market.
For sure. Yeah, that's an excellent question. And indeed, it all started really in 2019. So that's the moment that, the idea for Maple was conceived. And back then you really had, sort of the over-collateralized DeFi protocols.
Yep.
Starting to, gain market share. So that was obviously, Maker and Compound and Aave. And we quickly saw the need for more efficient access to lending, right? So, there you obviously need to over-collateralize all your positions, which is great for a segment of the market. But ultimately, if you really want to, in our view back then, if you really want to go mainstream, you needed to also provide under-collateralized loans. So we started facilitating that, and we sort of launched in 2021, and we quickly grew to $1 billion. So I think it, took about 9 months or so to get to $1 billion in TVL, and we were working with all the leading market makers like Wintermute and many others, and all loans were obviously on the blockchain, right? So fully built on Ethereum, and lenders could transparently see all of the interest payments, the loan size, the counterparties, and all those things. And then, everything was going very well, and, we saw a rosy future ahead. And then, of course, Luna happened, Celsius happened, and, there was a big collapse of credit in the space. And of course, if you look at history, you would learn that credit always happens in cycles, right? Yeah. You have a boom and then you have a bust.
Yeah.
The thing is, where Aave and Compound and Maker were very well positioned for the bust, even though they saw TVL contraction, they obviously had collateral that they could liquidate, right? We didn't have that. So we saw most of the borrowers actually repay. So most of the loans were well underwritten, and, probably about 96% or so of the loans back then were, closed out and repaid. But unfortunately, there were indeed a couple loans that weren't, right? So there were 3 borrowers that in the end couldn't repay, where one of them in the end did fully repay after a restructuring, but the other 2 didn't. And there we really learned our lessons. So we saw that, to do uncollateralized lending, the market was a bit too young back then to do that, right? Like the institutions weren't established enough, and all of the monitoring and risk management and things like that just weren't established enough. So then we landed in early 2023. So that was post the FTX blow up, and sort of in Q4 it was just sort of like managing the situation, crisis management. But then early 2023 we came together as a team, and we always knew we had this vision of bringing credit on the blockchain, and that vision was very, very much alive, right? It only became more alive because we realized that where we obviously failed in some areas, the other more centralized lenders, right, that didn't use the blockchain at all, they completely disappeared, right?
Yep.
Where like we were still around, and our losses weren't as bad.
So let's dive into that a little bit. So
for sure,
what is it like for those people who don't understand the lend borrow market? Why do people use the facilities that Maple makes available? What are they using it for? What are your sort of like biggest lenders look like? What do your biggest borrowers look like? And what are you facilitating? Why should someone care about this existing in the first place?
For sure. That's a great question. So, there's, very fundamentally, there are sort of 2 ways to grow as a business, right? Like one is to attract equity capital, and one is to, take out loans. Obviously, if you're just a startup and you're just getting started, you sort of, it's hard to take out loans, right? Like nobody's going to provide you financing. But, once you have an established business and you want to continue growing, it's typically better to take out loans because you don't actually have to give away your business to anybody, right? You simply can invest the capital, and if you invest it at a higher return than whatever interest you're paying, it's obviously a sound business decision. So what we see, we provide loans to borrowers at, call it 10 to 15%, right? And they then invest that capital and earn maybe 20 or 25% returns, right? And they could invest it in, growing their business, acquiring new users. They could have trading strategies. They can put on the basis trade. They can do arbitrage. They can do market making. Whatever their business model is, they can use that capital to grow. And then on the other side,
in terms of actual borrowers who are using Maple today, I mean that sounds like more like a debt financing pitch from the point of view of like, here's why this equity company should raise debt rather than equity, from the point of view of doing a bond or something like that. But obviously Maple is now focusing entirely on over-collateralized lending, and so all of those companies already have to have the capital. They have to have capital in Bitcoin, or have to have capital in ETH, or whatever other asset that they're borrowing against. So what are the institutions typically that are lending right now? What do they look like? And what are they borrowing for? What are you seeing? Because I'm assuming that you've not got sort of traditional Web 2 businesses that are coming in and borrowing against their equity, for example, or borrowing against assets that are off ledger. It's only on ledger assets that are being borrowed against, right?
For sure. And that's a great question. So today it's really crypto native institutions borrowing. And to your point, it's typically firms that are sitting on large amounts of assets. So think Bitcoin, Ethereum, Solana, other assets. And they have a long-term view on that asset, right? So they want to hold Bitcoin for the next, 5 or 10 years, because they obviously believe it's going to go up in value. But at the same time, they also want to grow other parts of their business, or potentially earn an additional return on those assets, right? So if they, for example, take out a loan against Bitcoin, at 10%, right, and they reinvest that and earn 20%, they are effectively earning a return on that Bitcoin, right, on their balance sheet.
Sure. And who are these people that typically have large positions in ETH and Bitcoin who are wanting to borrow against them? You mentioned market makers, which is sort of the first thing that comes to mind. But are there other institutions that people think about less in the crypto space that are also sort of keen borrowers?
For sure. It's a great question. So it's indeed the really large crypto hedge funds. It's some of the larger exchanges. So like, the Asian ones or the Western ones. It's the large OTC desks, prime brokers, sometimes family offices that have really large positions. So that's tend to be, crypto founders or OGs that, have built up large positions. And also VC firms. So sometimes you have, VC firms that are holding these assets or generally, more general asset managers. So it's really, I would say, any large crypto institution could qualify as a borrower. And most crypto institutions also hold large amounts of Bitcoin or ETH or Sol, right? Because they sort of, like they would way rather sit on those assets than on dollars, right?
Yep.
Because obviously, they view Bitcoin as like the new, store of value. So, and obviously you even have some traditional companies now adopting this philosophy as well, right? So MicroStrategy obviously being the first, but you also have Square, sitting on a pretty large amount of Bitcoin. And you're starting to see more sort of like Web2 technology companies also putting Bitcoin on their balance sheet. So over time, all of that Bitcoin could be used to unlock financing to grow their business.
And how difficult have you found it to be, obviously for your crypto natives, your DeFi natives, persuading them to sort of put their money into a smart contract is relatively straightforward because that's the game they're in. That's the risk profile they're taking. But for institutions, it can take a little bit more work. So how have you found that process and how has that changed over the years?
For sure. Excellent question. And that's also, I would say, where one of our core benefits comes in. So we don't require borrowers to post our collateral in smart contracts. So we allow them to actually post it in institutional custody, right? And if they require qualified custody. And that obviously has a whole range of benefits because we don't have to convince them on the soundness of these smart contracts. And many of these institutions are actually required by law and regulation to have their assets in qualified custody, right? So that's one of the core differentiators is that, yes, we have the same over-collateralized lending strategy as some of the, protocols we discussed, like Aave and Compound. Because we have such an institutional focus, we are, we have enabled that feature set in our product to facilitate that for institutions.
Interesting. So that sort of idea of qualified custody is sufficient. Obviously, I'm assuming that the collateralization on Ledger is still happening though. So there's still the possibility of getting liquidated, and ultimately the smart contracts are still managing the tokens themselves, or the idea of the tokens in custody are being represented on Ledger.
Right. So so the loans are still facilitated through the blockchain.
Yeah.
And there's indeed a margin call and liquidation process as well. So, where traditionally lending protocols sort of just do liquidations, we also have a margin call process, which is an official legal process that we agreed to in we call those master loan agreements, where a borrower is required to top up collateral within 24 hours if the loan falls below a certain threshold. Right. So a typical loan would look like, initial collateral level at 150%, at a margin call at 130%, and a liquidation at 115%. And that then gives obviously peace of mind to borrowers that they have time to top up collateral because obviously they don't like to be liquidated.
100%. Okay, and then on the lender side, obviously I think the crypto market, if you look at things like Aave and Compound and things like that, is clearly a stablecoin constrained market. It seems to be much easier to find people who want to borrow than it is to find people who want to lend. So how do you go about finding those people who have stablecoin, USDT, USDC, who want to lend on your platform, and what do those people look like?
For sure. That's a great question and fully aligned with you there. Like the key constraint at the moment for growth is, the ability to attract stablecoins, right? So that's also something that we've been extremely focused on in the last 2 years to really build up that process and capability internally. So I'd say, and that's also the reason we launched Syrup, right? So we sort of have two distribution arms.
Yep.
One is really Maple, which is institutional lenders, all accredited investors, right? They need to meet certain minimum asset or income requirements, go through KYC and allocate there. And those tend to be either high net worth individuals. So those are folks that have been a long time, in crypto, that have built up some on-chain wealth, or just generally speaking, Web2 entrepreneurs or people that are sort of, digitally savvy and looking for the highest returns. And that's also how we really attract those users, is that our yields are just higher than in traditional markets, right? So I think that is also showing obviously that there is a shortage of stablecoins in the system, right? Because borrowers are willing to pay up for stablecoins because there's a shortage there. And that's also how we expect more capital to flow into the space and more stablecoins to be minted, is because those rates are higher, right? And especially now with traditional markets, seeing rate cuts, the Fed is lowering rates, ECB, in Asia, obviously rates are very low. So we think that's a great catalyst for the space. So then on Maple, it's the individuals, and then, it's about four other categories. So one of them is DAOs and treasuries. So we are actually seeing quite a large expansion there now of the, large amounts of stablecoins on chain. The other one is family offices.
Sure.
So they tend to be a bit more open to, new strategies, right? Because it tends to be a smaller set of decision makers. So those are sort of the easiest, quote unquote, institutions to convince to come on chain. The other ones is we actually see more and more yield funds popping up. So those are just traditional funds that are allocating to yield on chain.
Yeah.
Because
it's a great source of yield. And if you're as a fund manager, if you're comfortable with the risk with smart contracts, you sort of intermediate between the people who are allocating to capital to you because they trust you, and your team who is allocating capital effectively within the market. Like it makes complete sense.
Exactly. And I think that's also really bullish for all DeFi protocols across the board, right? Because a lot of these institutions that would like to benefit from these yield opportunities, to your point, they don't like coming on chain. Right. If they can allocate into a traditional fund that their legal team can underwrite and understand, they effectively get the same exposure, but just through an intermediary, right? So I think that is sort of
and am I right in thinking that this is kind of how Syrup works and interacts with Maple as well, right? Like you have a fund structure in the back end that is allocating the funds into the KYC pools. Is that correct?
Yeah, so that's not fully correct. So yeah, because Syrup is really separated from Maple. So Syrup is completely offshore, where Maple is onshore, right? So in Syrup, US-based persons are not able to use Syrup. The thing is, but to your point, it is the same strategy, right? So it's exactly the same over-collateralized strategy as the Maple pools. Just all the borrowers and the legal side of things is completely managed offshore.
So Syrup and Maple don't interact at all.
Correct.
Got it. Understood. Okay, so like you had this institutional product which is now growing very nicely over sort of over-collateralized TVL specifically for institutions. So what was the thinking on Syrup? Why create Syrup? Why create a new set of products? And talk a little bit about the sort of like lead up to the launch of Syrup and then the last 3 months of Syrup.
For sure. Yeah, that's a great question. So, we were thinking internally, right? It's like, okay, we have this constraint of attracting stablecoins, which, you correctly identified. And we had a brainstorming session in March of this year in New York. And one of us brought up, what if we can tap into DeFi liquidity, right? Like that would be a fantastic source of stablecoins. There's obviously billions of dollars there. And then, this idea started to grow on us that we could launch a new product that would just focus on attracting DeFi capital, but it would still, deploy into the same over-collateralized, institutional lending strategy. So, we conceived of the idea syrup, adding the syrup to maple, right?
Yeah, no,
bringing the circle complete. And then...
You've gone heavy on the branding on that as well. Everything syrup has like got pores and slightly liquid, viscous feel to it for sure. Exactly.
Yeah, we needed some additional liquidity. So like, there's no better way to do that than adding some syrup. So yeah, Q2 was really about building it. So the engineering team just did a phenomenal job in building out the product in such a short amount of time. I will say that it's fully built on Maple smart contracts,
sure.
Right? So the pool infrastructure and things like that.
Sure.
We just benefit from that. And then in Q3, we launched it, right? And we scaled that pretty nicely. And the way that we validate internally that our thesis was correct is that 96% of Syrup users are completely new. So they haven't interacted with Maple before. So that really shows you that those are just two completely different user sets, right? Like one is fully on chain. Most of the time we don't speak with them. Sometimes we talk with them in Telegram, right? We definitely don't hop on phone calls. And then you have the Maple platform, which is everybody is, wants to hop on phone calls, and there's legal documentation, and, they do very deep diligence on data rooms and things like that. Where Syrup is like, our Gitbook needs to be super buttoned up, and the application needs to show everything, and so it's a really different user set, which is also fascinating to us. So we're also learning a lot about how to speak to those users, right, and how to engage them. And one of the key things we see is that partnerships with other DeFi protocols is really the way to go, right? So we landed a partnership with EtherFi, where they're now allocating from their liquid vault into Syrup. We launched on Pendle actually mid-October. It became a top 10 pool within 4 days, and attracted significant amounts of capital from mainly new users, right? So we're really monitoring that, how much of it is existing users going there versus new users. And then we also launched on the 22nd of October with OKX. So we are now fully natively available in the OKX application.
Nice.
So that's also very exciting.
And from the point of view of like, just so people understand, what makes Syrup different from something like Aave or something like Compound? Like, why are these net new users coming to Syrup instead of just allocating on the existing over-collateralized, decentralized, permissionless lend borrow platforms that already exist?
For sure. That's a great question. So let me start to say that obviously Aave and all the other ones are phenomenal products, right? So user of them, we love everything they build, and we also see them as partners. The thing that makes us different though is that we have consistent high yield, right? So we say that, not just as sort of like a marketing term, but we have actually done the work and done the data analysis, and our yields are consistently higher. And there's a couple of reasons for that. So first of all is that we have higher utilization rates. So we actively source borrowers, right? Where on Aave, it's just an open market. And it's like, okay, if a borrower shows up and takes a loan, it's great, right? But we actively have a pipeline of borrowers. We deploy loans. The moment deposits come in, we will, send 50 Telegram messages, and are like, okay, who's looking for capital, right? And we issue things out actively. So our utilization rates are higher. So that's like where the consistent part comes in. And then the high yield is, for a couple of reasons, we can take native assets, right, in institutional custody. So if a borrower wants to borrow an Aave, they need to wrap their Bitcoin, post it there, take a loan, and we can just take native Bitcoin, right? So it opens up a larger market, and borrowers are willing to pay a premium for that. We can also stake the collateral. So for example, we can take Solana as collateral. We can then liquid stake it, earn additional yields. So that's another way that we increase the yields. And then we also lock in the interest rates, right? So where on Aave, if you start seeing, for example, if you see prices dropping 4 or 5%, right? You directly start seeing a massive compression in yield, in rates, because borrowers, they just close down loans, and it's sort of like a risk-off environment.
Right.
Where on Maple, we actually issue, short-term loans, right? So we have fixed interest rates, which both as like a predictable cost of financing for the borrowers, which they like, but then also for lenders, we're able to lock in those higher rates. So because of those factors all combined, we have outperformed, these protocols, so Maker, Aave, Compound, by at least 5% over the last, 15 months, consistently, right? And often it's even, we outperformed them by like 10% plus.
That's very impressive. So let's talk a little bit about like sort of the future of Maple and Syrup and DeFi. Like, obviously you guys think very deeply about the future of DeFi. You have one foot in permissionless DeFi and the other foot in sort of institutional DeFi. What do you think what's the industry vision here? What's coming and why is this going to continue to grow?
For sure. Yeah, that's a great question. So I would say, this is something that we're very passionate about, and we have been very focused on the product, right? So far, just growing the product, finding product market fit, executing, and things like that. More recently, we have started to become a little bit more focused on the vision and like, where do we actually really want to go in the long term? So expect more from us on that side. Well, where we currently see things going is, a couple facts. Most assets are going to be tokenized, right? Like you even see people at BlackRock, saying that, Larry Fink, and
Sure.
This is really starting to become consensus, right? So that means that all those assets are going to be on chain, and that means that all these assets are going to be looking for utility on chain, right? So what does that mean for us? Way more stable coins, and all those stable coins, or not all of them, but a lot of them are going to be looking for yield, right? Because ultimately most stable coins are used for saving in the future. So they are going to be looking for yield. And the best way to obviously earn yield is through, attractive credit opportunities. And then on the other side, companies are moving all their assets on chain, right? And they want to unlock liquidity against those assets. So they want to borrow against those assets. Yeah. So it's not just going to be Bitcoin and ETH and Sol that we can take as collateral, but we will be able to take real estate, equities, bonds, and even more exotic things like art and watches and things like that. As long as there's a liquid market for it, right? Then we will be able to take it as collateral. So we really foresee a future where we are sort of at the core of, global lending markets, and everybody that's looking for a loan, right, will have some asset that is tokenized that they can unlock liquidity against. And we will then be plugged into all of these different platforms and protocols to facilitate that happening. And then, all of these opportunities will sort of be bundled up in pools, right? And each pool is going to have a different strategy, a different liquidity profile, a different risk profile. And as a global citizen, you can just allocate into your strategy of choice, right? And you can then obviously bundle them as well to sort of diversify risk. And the other exotic thing that we foresee and that we're currently experimenting with a little bit is that AI agents are going to be running a lot of those strategies, right? So we very much think that humans are going to be setting the framework, right? And sort of like the bands in which the AI agents can operate. So it's like, okay, this is a pool for, underwriting loans against Dutch residential real estate within, these certain brackets, right? And then the AI agent can just, source loans and underwrite loans, within certain concentration limits and certain liquidity requirements, right, for the underlying real estate. And that's going to allow, not just us to be a lot more efficient internally, but it's also going to allow consumers, to be able to get loans way faster. So we foresee a future where you just, take your phone and instead of ordering an Uber, you just take out a loan against your house, or, your piece of art that's like worth a lot, or your portfolio of like AI stocks, or your portfolio of meme coins, right? Or your portfolio of NFTs.
Yeah, I think one of the interesting like sort of AI agents, I think of there's a lot of power in them. There's obviously a lot of risk at the moment in terms of their hallucinations and things like that. The thing to solve there, as far as I can see in the market, is the illiquidity problem of the collateral, right? So when you're looking at crypto and you're looking at the sort of the top 50, you have highly liquid assets, and then as you go down the list, it starts to get more illiquid. As soon as you start to bring in things like real estate, as soon as you start to bring in things like sort of company equity that isn't listed, and even sort of some company stocks, like the top stocks have very deep liquidity in the same way that top crypto assets have very deep liquidity, but as you go down, it becomes more illiquid, and a lot of the sort of risk in that, the tail risk in that, is hidden. So what's your view on how the liquidity problem, because obviously you have to be able to do liquidations, how the liquidity problem is solved, especially when it comes to things like I'm borrowing against my house and suddenly, for whatever reason, the bottom falls out of the housing market, which we always thought wouldn't happen in 2008 and then did. So like how does that bit get solved first before you get onto the how do I write loans against this?
For sure. I think that's a great question. So I think there's a couple of factors there. Like obviously one is sort of the LTV ratio that you can play with, right? So you can have more conservative levels to account for the liquidity. Even, let's say the housing market as an example, even though there might not be as much like primary liquidity, for on a daily basis, there's still a pretty clear floor price, right? So it's like, if you put a house for sale in a certain neighborhood that, has a certain turnover every year, for a 10% discount, it's probably going to get bought up pretty quickly, right? So I think, so I think that, as if you have these global markets that are really developing, then I think, the inefficiency in the market is also going to be, the markets are going to be more efficient, right? And as markets then become more efficient, it allows for more certainty in underwriting these loans.
Yeah, I think for real estate, I've often thought about real estate a lot, because it's one of the first assets that people tried to tokenize on blockchain, and it's one of the assets that has consistently failed as a tokenization asset. And the big reason is because it's so idiosyncratic. Like I have to understand New York real estate to understand whether or not buying a tokenized version, a tokenized share of a skyscraper or a house in New York in a particular area is worth it. Like there's so much specific knowledge that has to go into understanding that. But in the traditional markets, that has been solved to some extent with things like REITs, real estate investment trusts, and in loan origination, if you're thinking about sort of like books of loans, you have this concept of securitization. Hey, I'm going to just bundle together a bunch of things, and then you have this sort of layer in between, where you have a liquid product. And that liquid product then has the has the capital and the liquidity and the specific understanding of the underlying asset to abstract that away from the person who wants to get exposure to it. I'm yet to see that in crypto. I think that is going to be a big unlock when people start to understand, okay, we want to start doing credit. Let's say we just want to do personal loans, payday loans, or buy now, pay later loans, or whatever. There's a bunch of companies that are doing very well in the Web2 space that are doing that. But how can we abstract away the idiosyncratic risk, the sort of the thing that you have to know specifically, and just focus on, hey, we've got this book of assets that has a value, and we're saying that it has a value because there's these parties who are involved who will make sure that it has a value, because there is this floor price that's established essentially because there's always a willing buyer to buy out. Like the protocol, if it wants to liquidate a house position against a loan that's being provided, doesn't want to be waiting around the 3 to 6 months it takes to do the conveyancing. There has to be that intermediate party who just buys it out. And in the same with, payday loans or buy now, pay later loans or credit cards, like the credit card companies actually don't do the collections. Like generally the collections are sold on to collections companies, and then they take the residual value back of that into their book. And then there's some way of like sort of offsetting some of that risk on the equity value of the company because their first loss or whatever. Like there's a bunch of stuff in Web 2 and traditional finance that works this out. So I think that there's still a way to go. I think that I agree with your vision. Like the next thing that's going to happen after crypto assets is going to be real world assets. But I think we're going to be sticking to the liquid assets first for a while, sort of the liquid bond markets, government bonds, potentially sort of like AAA rated corporate debt that has very liquid markets, potentially some of these sort of like well traded equity, public market equity companies. And I think that's enough for the next 4 years of growth. There's trillions of dollars there, just in those markets.
For sure. Yeah, fully aligned there. I think there's indeed some things that need to be worked out. The only other thing I would add there is that because of this AI revolution that we're going through right now, a lot of those things of knowledge about local markets and specifics on houses and things like that are all going to be democratized, because those AI models will sort of have that knowledge as well, because they have access to such large amounts of data, right? So, and then you can start seeing AI agents not just managing pools on Maple, but also managing trading portfolios where they actually buy up these assets that are being liquidated, right? And, because they have, so there will be a massive race for whoever can have most knowledge and data on all of these local markets, right? Because they will be able to make more intelligent purchasing decisions. And that will then in turn also enable all of the liquidity, right? Because there's going to be so many arbitrage opportunities between all of these different markets and mispricings and things like that. And, once like markets will really start to have an incentive to like uncover all of that, and because they will also have the ability to actually take action on it, right? Like right now, imagine if you're running a hedge fund in the US, like try to buy a Dutch piece of real estate. I mean, it's simple, like it's very hard, right?
Right.
But if you can just instantly buy and sell it, and to your point, it's probably going to start with REITs, it's probably going to start with baskets instead of individual properties. But you can quickly, see markets, developing. So it's really sort of like all these factors combined. And to your point, this, might not happen in the next 2 or 3 years, but I do think in, 2030 and beyond, this is really what we're going to see. And we are we're really excited about that.
Like ultimately, I think the strongest argument for tokenization is clearly the ability to borrow against those tokenized assets. That is the single biggest argument for tokenization. There are a bunch of like, I would say like sort of administrative operational ones, and sort of like cost savings in association with issuance, with association with sort of managing rule sets and regulation and compliance and all that kind of stuff there, yeah, for sure. But I think the single biggest unlock is instead of holding, if you can hold a fund in a traditional structure, that fund is basically illiquid. Like you have an asset, but it's not really useful. You can't borrow against it. Or you can via prime brokerage, but it's complex and finicky and tends to only be unlocked from the point of view of if you've got a very large amount of capital. Whereas if you have a tokenized version of it that's liquid, as soon as you have that, all of the other opportunities emerge where you can leverage, where you can borrow against, where you can do all of these things that are available really only to the very, very large fund managers, very, very large hedge funds, or very wealthy private individuals. And I think that unlock for tokenization is tokenization plus borrowing is the single biggest unlock for DeFi that's coming over the next, I don't know, probably the next 20, 30 years. That it's just going to be a continuation of that. And I think that's the narrative for me. Like the two primitives of DeFi, three primitives of DeFi, but are swapping, borrowing, and derivatives. And as those have an interplay with each other, and as those push into more and more real world assets, you're going to see more and more flywheel effect of being like, well, why? Like right now, it's like, why would I hold a tokenized version of this? I think eventually it's going to be like, why would I ever hold a not tokenized version of this? Like I have so much access to all of these tools, to all of this extra capital, to all of this leverage, to all of this ability to borrow, to all of these liquid markets that are inherently global. Why would I not do that? Why would I go and buy it in a traditional fund structure? And I think it's really exciting, and it's great to see you guys building towards that vision as well.
Exactly. Beautiful. It sounds like music to my ears. And indeed, it's like, why would you hold a physical business card if you can just have somebody's, LinkedIn profile and Telegram and email and,
maybe you just really like
available.
paper. Maybe you just
Exactly.
want to recreate the scene from American Psycho. But no, I completely hear you. Yes. There will always be those who are nostalgic about what has gone, but I agree. Like everything else is pushing forwards. It's been such a pleasure talking with you, Martin. Thank you so much for coming on the show. If people want to find out more about Maple or Syrup, where's the best place to get started?
For sure. Great question. So best place would be to go to maple.finance for Maple and syrup.fi for everything syrup. And of course, you can also find us on Twitter.
Awesome. Thank you very much.
For sure. Thank you too. It was a pleasure to be here, and thank you for inviting me.
Need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.